Today, we are unpacking and talking about one of the most misunderstood and misrepresented tools in all of retirement planning, annuities. Some advisors love them, some advisors hate them, and the financial media's reporting on annuities is, well, it's a complete mess. The truth about annuities, well, it depends on your goals. Welcome to Carolina Retirement Club, where we help couples in the Carolinas build their retirement plans, protect their wealth, and enjoy the life that they've earned. So what exactly is an annuity? Let's break it down. In its most fundamental, basic sense, an annuity can be broken down into a stream of payments. So think about any ongoing, regularly occurring stream of payments, and technically, that's an annuity. However, when it comes to retirement planning, when most people hear annuity, what they are understanding that word to mean is a contract from an insurance company. So if we are going to discuss annuities in any meaningful way, we first have to define terms. So let's break it down and let's talk about the 5 specific types of annuities. The first type is the easiest, most vanilla type of annuity, and that is an immediate income or deferred income annuity. You give your money over to an insurance company, and in exchange for that lump sum deposit, the insurance company is going to return to you a stream of payments. Those payments may begin immediately, or you may be able to defer those payments for a period of time. That's why these annuities are referred to as immediate income annuities or deferred income annuities. Very simple, easy to understand, straightforward. The second type of annuity is a fixed annuity. These annuities are principally protected and they offer a fixed rate over the life of the contract. For example, if you were to have a 5-year contract that paid a 5% rate of return, that 5% will be guaranteed or contractually guaranteed for the 5-year period. Now, you do want to clarify, is that 5% simple interest or will it be compound interest? Right? You want to make sure you understand the difference between those two. But again, these are fairly vanilla contracts. It's going to be a fixed contract, meaning principally protected, and you get a rate of interest that is contractually guaranteed over the life of the contract. It's important to note that these annuities can have surrender penalties and there may be some liquidity restrictions. So it's not going to be like a high yield savings account or even a CD at the bank. They tend to be a little bit more restrictive when it comes to liquidity. So you want to understand exactly what you're buying. The third type of contract is a fixed index contract. So these contracts are also principally protected. They offer crediting strategies where instead of investing directly into the market, you can invest and link your funds to a market index. Now, in the early days, these indexed annuities were very vanilla, very straightforward, where you would link to a very well-known or transparent index. In recent years, more and more fixed index annuity contracts are having proprietary indices, black box crediting strategies where they're quite complicated. And many of the people that are even selling them could not articulate how the crediting strategies actually work. Your ability to earn credits can be limited by caps or participation rates, or you may have buy-up rates where there's the ability to earn, but you have to pay a fee. It's getting more and more complicated, but the nuts and bolts of fixed index annuities are, 1, they're still principally protected instruments. They have the ability to earn credits based upon some type of market index, and they also have the ability to add lifetime income benefits or living benefit riders, where instead of just using the annuity for accumulation, you may actually start being able to look at using the annuity for retirement income planning and distribution strategies for your retirement years. The fourth type of annuity is something referred to as a RILA, or a registered index-linked annuity. Now, these annuities are the first of the two types of annuities that are actually securities. What that means is that you have to have a securities license or a special securities license to even sell these types of annuities. Why? Because we are no longer in the principally protected universe. RILAs and another annuity referred to as a variable annuity, both you can lose money based upon a market decline. And that's very important to remember. Now, what sets RILAs apart from just a regular variable annuity is these annuities may offer a fixed option, but most of the time they are built to offer a buffered type strategy, which means that there is some downside protection, but because there are some downside protection, there may also be some upside limitation, where these annuities don't necessarily give you all of the losses. In many cases, they may not give you all of the gain. So these are no longer in the principally protected universe. They also now offer the ability to earn a little bit more, but to earn a little more, you may have to be willing to risk it. In addition, these contracts can offer lifetime income benefits, or those living benefit riders. However, at least in my experience, I have seen those income guarantees being offered by the insurance company they tend not to be as generous as something on the fixed index side or on the income only side. The last or fifth main category of annuities are referred to as variable annuities. These types of annuities are possibly the most widespread or pervasive type of annuity that is out in the marketplace. These type of contracts are not offered by somebody who has an insurance only license or someone who's just an insurance agent. You actually have to have a series license to sell variable annuity contracts. Now, the world of variable annuities is extremely vast, and it is impossible to cover it concisely in just a couple of moments. But here are the high-level points. The first thing that I would tell you is in the name. If it is a variable annuity contract, that means your results with that contract may indeed vary, because the funds or the way that you invest money into a variable contract is in something referred to as sub-accounts. These sub-accounts bear market risk. So while yes, you may receive a nice upside growth potential inside of a variable annuity contract, it is also possible to receive the market losses inside of a variable annuity contract. So this is not a contract that is principally protected. I have seen in my experience added riders or certain living benefits that add a layer of return of premium or some type of step up of protection for your accumulation in these policies, but it comes at a cost. So anytime you're going to pay an explicit fee inside of a contract, you need to understand exactly what that fee is covering. Which brings me to one of the biggest downsides to variable annuities is they tend to be the most expensive type of annuity contract to own. Annuity contracts in general can be very, very simple with no fees, or they can have multiple layers of fees depending on what you're buying, the type of annuity contract that you own. So it's important, if you're going to look at variable annuity contracts, you want to first understand what the total expenses are going to be inside of that contract. Most, if not all, variable annuity contracts have a contract fee and a mortality and expense fee. In many cases, these fees can be at least 1% or greater. I do know that there has been some fee compression, but I would say first you want to understand what that fee would be. Next, if you're adding any additional benefits, are you adding an income rider? Are you adding a death benefit rider or any other type of living benefit? What are the fees not only today, but what is the maximum potential fee that you could be charged over the life of that contract? The last expense that you need to understand that comes with variable annuities that does not come with other types of annuities are the internal expenses on the investment sub accounts. And they could range to be very inexpensive to very, very expensive. It is not uncommon to see internal expenses on variable annuities range between 2.5% to 4.5%. Now, there may be somebody out there that loves variable annuities and they have a very good track record of using them wisely and placing them in a way that makes sense for clients. But let's not dispute the fact that variable annuities do have internal expenses, and in many cases, those expenses are understated when speaking to clients. The big takeaway I want you to understand with variable annuities is A, these contracts are variable, meaning your results may vary. They also tend to have the highest internal expenses of all the different types of annuities out there in the universe. Now, that's not to say that internal expenses are completely bad and never consider them. That's just to say these tend to be the highest inside of variable annuities. So we've covered the 5 types of annuities, but remember, annuities themselves are contracts. Before you enter into any type of contract, you want to make sure that you understand the terms. A couple of great questions to ask are, what is the financial rating of the insurance company? How are they rated? Is it an A or an A+ rated carrier? What are the term limits of this contract? Is this a 5-year contract, a 7-year contract, a 10-year contract? If it's longer than a 10-year contract, I would ask why we need the extra contract length. I've seen annuity contracts in some cases that were 15+ years long. Now, they may have a great reason to be a 15-year contract, but I would really need to hear that explanation. You also want to understand not just the contract length, but what is the surrender schedule or the penalty schedule. Remember, annuities are contracts. So, for example, if we place money into a 5-year or 7-year contract and that contract has a penalty or a surrender schedule, you want to know, what does it look like if I need to access my money in year 3? Now, it's important to understand that most, if not all, annuity contracts have some liquidity provisions where if you needed to access your funds, there is a penalty-free withdrawal. So you want to understand what the penalty-free withdrawal looks like, because that does allow for some liquidity. But the other thing is that if you felt like you needed more than that, that's where those penalties apply. So I think a good rule of thumb is that if we're going to look at a contract, we want to understand all the terms of the contract. And most importantly, we want to know what that contract is contractually bound to do. So what will the contract actually do? Not what it might do. Because a lot of annuities are sold based on potential or what they might do. But I like to say, what's the worst case scenario? Can we live with the worst case scenario? Because yes, it may not be likely to happen, but what if it does? Whew, that's been a ton to cover, but hopefully that creates a framework where we can begin to talk about annuities through the proper lens and through the proper perspective. Now let's talk about, why might retirees want to consider an annuity? Annuities can offer a solution for several areas of concern that are unique to retirees. For example, annuities have the ability to offer a contractually guaranteed lifetime income stream. To my knowledge, there is no other contract or no other financial product out there that will continue paying you money if the balance goes to zero. For instance, if I had a portfolio and I was making withdrawals and I withdrew my last dollar from that portfolio, I do not have any more money to withdraw. If you're in an annuity and that annuity is paying you a contractually guaranteed lifetime income, by default, that additional money that is paid out to you is referred to as mortality credits, meaning there's no money left in the policy. There is no balance for your heirs to inherit. But because the annuity company is contractually bound to continue paying you, you will continue to receive those paychecks until you die or until your spouse dies. So an annuity can solve for that real concern of outliving your money or outliving your paychecks. Another area where many retirees have concerns is the stock market and stock market stress. Now, I'm an investor at heart, and I love the wealth building potential that our equity markets offer all of us. However, when someone has been building and protecting their wealth, like building and accumulating their wealth, planning for their retirement years, they become a little bit more vulnerable to those downside market events. If someone has lived through the dot-com bubble or the 9/11 recession or the great financial crisis, or more recently COVID or the bear market of 2022, we all know that yes, the market can get hit really hard, and yes, the market tends to recover. The timing of that recovery is not guaranteed, nor is it uniform across the board. It can completely vary, and that creates a ton of stress. So for those people who don't necessarily want to continue taking market risk with all of their dollars or continue on that roller coaster of emotions, they may want to find a way that they can safely accumulate some assets. And when I say safe, what I'm referring to are the fixed or the fixed index contracts. These are contracts that are principally protected. So it's safe from the standpoint that these funds are not directly invested in the market. Those types of contracts are not designed to compete with market growth portfolios. That's not what they're for. What they are there for is for a way for you to get a competitive rate of growth in something that is not going to bear market risk. And those competitive rates of growth depend on a lot of different factors. It depends on what's going on in the economy. It depends on the current interest rate environment. It depends on, how those different carriers may even price their contracts. But understand what you are not trying to use as a proxy is you're not trying to take something that is a fixed or a fixed index contract and compare it with a market growth portfolio. This is just something that you want to use where maybe you can get a better growth rate than what you can get at the bank or in a CD or in a high yield savings account. At least that's my opinion. Another way that retirees may want to consider looking at annuities is for the income planning benefits. Some annuities have the ability to add contractually guaranteed income benefits, where you can contractually guarantee it for one life, or if you're married, you might even be able to contractually guarantee it for 2 lifetimes. You're able to take what may be one spouse's retirement account and turn that account into something that provides a joint lifetime income. This creates a lot of opportunities when it relates to income planning for retirement, where you have predictability and control over when you want to start the income payments. So it can create a lot of flexibility for income planning, where you may want to create an income for a certain period of time, or you may want to create a lifetime income benefit. One additional feature that ties into that, but I love to talk about this as a standalone, is the surviving spouse plan. In many scenarios, we'll see people come together and they have a plan put together. They've got their taxes put together. They've thought about RMDs. They've looked at their asset allocation, but they don't have a plan for the surviving spouse. The surviving spouse's plan is, well, they'll have all the assets and they can just, figure it out. That's not a plan. So what we want is we want to create a plan that not only works for you guys as a couple in retirement, but we want to create a plan that also specifically considers the unique position of a surviving spouse, not just from an income standpoint, but also from a tax standpoint. And so annuities have the ability to create joint lifetime incomes, where you have the ability for that income to continue as long as one of the two spouses is still living. This is a tremendous planning tool, and I think many people should consider it, especially if you're looking to build a retirement income strategy. The last thing I'll point out is that annuities are considered to be retirement vehicles, where the growth in all annuity contracts, any growth is tax deferred, and you have to be mindful of when money comes out of how those dollars are taxed. Now, if it's an IRA and you have an annuity contract that you purchase with IRA dollars, as we know, those IRA dollars, when they come out, they are taxed as ordinary income. If you are purchasing an annuity with non-qualified dollars, the growth in that contract is going to be tax deferred. One, if you're a high income earner and you're looking for ways to shelter excess cash or excess non-qualified assets, If you've exhausted all of your other options, if you've maxed out your HSA, if you've got a fully funded emergency fund, if you've maxed out your 401k potential, and you've looked everywhere you possibly can, then the last place you can consider, I shouldn't say that. It's not the last place you should consider, but it's one of the last places you should consider is looking at an annuity, because annuities have the ability to give you tax deferral on the growth, which can help for certain families who need that and may make sense for certain tax planning strategies. So that is a feature that these offer, but in many cases, I wouldn't say it's the primary thing that you should look at when coming with an annuity, specifically because many people have the lion's share of their assets already in IRA or 401k or 403b dollars. They already have the lion's share of their savings in these tax deferred buckets. So it's not necessarily about tax deferral. In my view, it's more about how are you using this tool for retirement? Is it something that you want to be protected from market risk? Are you trying to use it for income planning? Are you trying to use it for a joint lifetime income plan? To me, those are higher priority items than looking at it from a tax deferral standpoint, because again, if the dollars are already in a tax deferral wrapper like an IRA or a Roth IRA, 403b, 401k, any of these wrappers, then the tax deferral piece is completely a moot point. So let's be honest, annuities are far from perfect, and anyone saying otherwise is just not being straight with you, right? They're a tool, just like anything else. There are no perfect financial products. There are no perfect financial strategies. Everything has trade-offs, but there seems to be this just perpetual myth that all annuities are bad, and that's simply not true. If you use the wrong annuity or you use an annuity in the wrong way, it can create problems. And since these tools are often sold instead of integrated into a plan, in many cases, these are just product sales. However, like any tool, if you use the tool correctly, it can provide a ton of benefits. So if you're looking into annuities, or you're curious, or someone's pitching you an annuity, or you're doing your own research, here are a few things that you can look out for, a few topics that you could ask about to get better informed so that you can make a good decision. First, I think you should look at what are the financial strength ratings of the insurance company. Is it an A-rated carrier? Is it a B-rated carrier? Is it A+? What are the financial strength ratings of the insurance contract? Anytime you look at a disclaimer when it comes to annuity income, they will always talk about insurance claims are subject to the strength of the carrier. So you want to understand, is this a financially strong company? Secondly, you want to understand the terminology and the terms of the contract. Yes, this can be dry and boring, but it's very important. You wouldn't want to sign a contract if you didn't know what you were signing, correct? So understand, what's the length of the contract? What's the type of contract? Go back, listen to the video again. There are 5 different types of annuities. Do you know what type of annuity you're talking about? What are the surrender schedule penalties? What are the liquidity provisions? If you want to have some access to your funds, how does the liquidity work? How will the contract make money? Is it a fixed contract? Is it a fixed index contract? Is it a variable contract? All of these contracts have the ability to earn credits and earn interest. However, they are very different. So know how you could possibly earn money. Will your principal, will your capital be at risk in the policy? Does the contract itself bear market risk? That is a critical component. I cannot tell you the number of times in my career where I've sat down with people to review different types of annuity contracts where the person didn't understand what they actually owned. Lastly, understand the fees and expenses in the contract. Fees and expenses are not necessarily bad. I don't know anything worth having that doesn't have some type of cost. but there are explicit costs and implicit costs. So for instance, if you're in a fixed index contract, you don't get all of the market upside. So some would say that that's kind of a hidden cost of the policy, where if the contract is linked to the market and the market has a great year, well, you're not going to capture all of that gain. And some people would frame that as a cost, right? But it's not an explicit cost. Again, fees are going to matter. So the higher the internal expense of the contract becomes, in my view, the less that contract has the ability to earn over time. It's totally normal to ask questions. In fact, I would encourage you, for anything that seems too complicated for you to understand, that should be an area where you drive in or dig in a little bit more to know more about what you're actually owning. The last two things that I will leave you with, these two, in my opinion, are the most critical. First is understand and remember that annuity contracts are contracts. You want to understand what the contract will do. What are the contractually bound terms? Meaning, what will this contract do? No matter what, not what it might do or what it can do or what's possible. What is the worst case scenario? Can we live with a worst case scenario in this contract? And if we can, then everything on top of that should be a bonus. The second thing that I think is just essential is understanding who you are purchasing an annuity contract from. And this is an area that is just rife with disagreement within the financial community, but I think it's important for any consumer to know who you are working with. Certain annuity contracts only require a life insurance license, while other annuity contracts require a full-on securities license. That doesn't mean that insurance-only agents are not looking out for consumers, and that doesn't mean that anyone that's a broker or someone who's got a securities license is totally trying to get one over on consumers. But I think it's important for you to understand the experience and the competency level of anyone making an annuity recommendation. The reason why is there are certain contracts that cannot be sold by certain financial professionals. So you want to understand, can this person sell you any type of contract, or are they limited to a certain universe? Secondly, are they bound with any type of proprietary or captive agency? Meaning, are they able to be independent and shop out solutions, or do they have a very narrow window that they can only shop or only place contracts from a very specific or limited set of carriers? To me, all of this should be disclosed up front before you make any buying decision. It doesn't mean that the tool that's being proposed is inherently bad. It doesn't mean that the tool being proposed doesn't work for you, but you do want to understand who is making the recommendation, what is their competency level, what is their experiency level, and how are they compensated? I think these are all fair questions. This is my opinion, but I just believe that these types of tools need to be used within the context of a retirement income plan. This should not be just a product sale. So if it's not being discussed in a manner that says, hey, this is how this tool works in the plan, this is how it's going to be used, this is how it makes sense and the benefits will play out for you over time. If you're not having those types of conversations, then in my opinion, you should be looking to find someone that can help you integrate that into an actual plan. We've covered a lot in this video. Probably too much for one video. So if you made it to the end, congrats to you. Now, here's what I recommend. If you are considering an annuity or curious about annuities and wanting to do more and do a little bit more research, or maybe you even have an annuity and you're like, I don't even know what I own, then here's what I would do. Click on the link below and download our annuity buyer's checklist. This is a simple checklist that you can use to evaluate or ask good questions for anyone discussing an annuity with you. Or if you'd like, click on the link below and book a retirement vision call with our team today. We'll discuss your goals, your visions, and help you create a plan that can build the retirement that you're thinking about. So don't hesitate, reach out to us today. Hey, thanks for watching this video and for joining us on Carolina Retirement Club. If this video made sense to you or if you found value out of it, don't hesitate to hit that subscribe button or share this video with your friends or somebody that you think would get value from it as well. Thanks.